Building a dividend income stream that can help you to retire on passive income may seem really daunting and even impossible, but it's actually quite doable. In this video, I'm going to discuss a very, very realistic blueprint that you can pursue to retire on dividends in just 10 years. So I hope you'll stick around and learn how that works. Okay, so what does it all begin with? Well, really what you need to start with is building up a $100,000 passive income snowball. That's what Charlie Munger spoke about. Now, it was a number of years ago. I know the dollar's not worth as much today, but even operating just on that $100,000 assumption, I think you can get there. And basically the point he made with that $100,000 snowball was really just in the process of building up a $100,000 snowball, you got to build the discipline and the mindset, the savings mindset, that to get you to that point, you're probably on the way to long-term financial success. Additionally, getting to that level of $100,000, a six-figure savings and investments portfolio, that can boost your self-confidence, and it also can free you up to pursue more aggressive investments, perhaps maybe take on some more chances in your career or your business that will help you to further accelerate the compounding process as well. And so with that in mind, in this video, I'm going to talk about exactly how to get from a $100,000 snowball to retiring on dividends in just 10 years. Before I get into the details though, if you like this sort of content, dividend investing strategy, portfolios, individual stock and ETF and CEF analysis, my macro analysis, etc., please subscribe to this channel. I put out numerous high quality videos for you to benefit from each week to make you the best dividend investor possible. Thank you very much. All right, so let's talk about how we're going to go about doing this. Well, first of all, again, you got that $100,000 portfolio, and my assumption is you're targeting a 6.25% dividend yield. Now, why 6.25%? Well, that's just the way the math works out to be as low as possible to still achieve your goals. And I think 6.25% is not unreasonable at all today, because you have treasuries that are not that far below that, and so that's only a slight risk premium. And additionally, if you're intelligent about how you approach dividend stocks, you can get some pretty high and actually quite sustainable yields. You just have to be smart about it. And then obviously got to balance that with dividend growth. And so that's the other aspect. I'm assuming 4% annualized dividend growth. And so that's taken into account here. And that's why the yield doesn't want to be too high, because you do want to have a good growth component. Now, the other assumption I'm making is that you can live on about $60,000 a year, $5,000 a month. And I think that's reasonable for someone who's committed to early retirement. You got to be frugal. You're not living large off the land. And, presumably this is just for one or two people. It's not for, a family of 10 kids. And so obviously there are some people who, two double working households, but even if you just have one job, I'm assuming in this video that you live off of $5,000 a month and you earn $100,000 a year. Now that may not be accurate, but that's what I'm rolling with. And so the assumption is then in 10 years, you're going to retire on $60,000 in dividends. That's $5,000 a month. And of course, you may have Social Security at that point. You may have a side hustle. You may have a pension. Who knows what else you'll have. But at a minimum, I think that's enough to live off of. Again, if you're a relatively thrifty, frugal person, you don't live in a high cost of living area, you live in a low cost area, you can do this. Now, of course, you can adjust these numbers to fit your own goals, your own situation, but this is what I'm rolling with. Now, the most conservative assumption I'm making is that I'm assuming no raise during that 10 years. You're just going to make $100,000 every year. So some of you may think, well, those assumptions are unrealistic, Samuel. Okay, fine. But if you live in a high cost of living area and you're spending a decent bit, presumably you're going to be, hopefully your goal is I'm going to earn more than $100,000 a year. I'm going to be getting raises, or maybe you make less than $100,000 a year today. Maybe you're a solo income household. That's totally fine. But over 10 years, let's say you're making $60,000 or $70,000 today. But if you work hard over those 10 years, you can easily clear that $100,000 hurdle, especially with inflation. Maybe by the end, you'll be making $130,000 or even $150,000 or $200,000 a year, especially if you bring in a side hustle or dual income household, et cetera. There are different ways to go about it, and you can easily clear that hurdle. So again, I don't think these assumptions are unrealistic at all. So those assumptions in mind, how do I approach the portfolio? And really, again, I'm just going to show below here on the screen how this math works out and how it adds up to what I'm talking about. Okay, so how do you go about doing that? Well, I think the importance is to be diversified properly. You could just target a single stock that yields 6-7% and pays that growth rate. For example, Enterprise Products Partners pays a 7% next 12-month distribution yield. It's tax advantage. You don't have to worry about that. It's a 4, 5, 6% annualized rate, and I expect it to do so for the foreseeable future. So you could just buy EPD and be done with it, or you could even buy the Alarian MLP ETF, which is diversified MLPs that will give you pretty similar numbers, maybe a slightly higher yield, maybe slightly lower growth, effectively the same thing. You could do that, but you're completely concentrated in a single sector, and I think that's a little bit risky because if energy really hits the doldrums, or some other event takes place with one of those companies, you're putting yourself at some risk. And so I think it's good to at least be somewhat diversified, although I do love the MLP sector. And so in today's video, I'm going to talk about how to build a good diversified portfolio to get you on this path and still meet these objectives to optimize your risk-reward profile. Okay, so what are the sectors? Well, first of all, I think grounding your portfolio in some diversified ETFs can really go a long way. So, for example, the Schwab US Dividend Equity ETF, I like that a lot. It has a low expense ratio of just 0.06%, making it one of the lowest cost funds out there. Has a near 4% forward-looking dividend yield. It has a long track record of growing its dividend at a double-digit annualized CAGR. Now, for my assumptions here, I'm assuming a lower dividend CAGR than that just to be conservative, but you can't argue with the dividend track record. It's diversified across over 100 individual holdings that are blue chip dividend growers, and it is also diversified across a number of different sectors. So you get that nice underlying strong dividend growth, decent dividend yield, good diversification across blue chips. It's just a nice 4-year portfolio. Then you can complement that with a covered call ETF for tech exposure, like the JP Morgan NASDAQ Equity Premium Income ETF has JPQ, or you could do the NEOS one, that's ticker symbol QQQY, and that gives you a double-digit yield. Again, diversification to the leading mega cap tech stocks that are not in and wouldn't otherwise pay much of a yield. And that gives you that nice monthly cash flow and a very attractive yield on top of it. So I think those are two, and that's obviously going to be a smaller holding than SCHD because the covered calls are a little bit more shaky. You're not going to get the dividend growth from it. It's a little bit more sector focused. And so it's a smaller but nice, still important complementary piece alongside SCHD to lay a nice strong foundation for your portfolio. Okay, what am I going to layer on top of that? Well, maybe some fixed income. So maybe you want some preferreds. And there are two funds that I like. They're both by the Virtus InfraCap group. There's PFFR. That's a REIT-focused preferred ETF that has no leverage. It's index passively managed, has a near 8% yield. And then there's PFFA, and that's actively managed, has some leverage on it, but it yields like over 9%, has a very impressive track record. It's been growing its dividend in recent years, albeit slowly, but it's also been crushing the overall performance of the broader space with funds like PFFF when you compare it to them, and even leveraged CEFs that invest in similar investments, PFFA is still beating them. And so when you have those in your portfolio, it gives you a little bit somewhat contractual fixed income, higher in the capital stack, but that high yield. And so that blends nicely with QQQI. You're getting an aggregate nice high yield, but remember, you're still getting that strong dividend growth from SCHD and additional diversification. I'm going to add more layers on top of that to further round this out. So for example, in the infrastructure space, you have the likes of Brookfield Infrastructure Partners, Brookfield Renewable Partners. Both of those are leaning heavily in and aggressively into the AI boom. They have attractive yields of around 5 to 6%. They're growing their dividends or their distributions at a mid-single digit pace. So again, that gets you close to your target yield, even a little bit faster than your targeted distribution growth. Again, that blends in nicely where we were probably already on the high end of what we needed for the yield from those other holdings, but a little low on the aggregate dividend growth. So this helps balance it out a little bit more, further diversifying the portfolio into renewable power, hydropower, nuclear from BEP, and then on the BIP side, you're getting transportation assets like toll roads and ports and shipping containers and railroads, along with some midstream regulated utilities, and then you got the data AI infrastructure like data centers and towers and fiber, etc. What else am I add on? Well, then I'm going to go with an alternative asset manager like Blue Owl Capital that has around a 5% dividend yield, so a little on the low side there, but is expected to grow its dividend at a double-digit CAGR moving forward. So that, again, provides some nice dividend growth to supercharge that component of things. And that one, of course, is a whole other experience. You got permanent capital, fee-based earnings from a wide array of holdings, whether it be direct lending, other asset managers, and then you got triple net lease fund, real estate fund that they manage, and then a digital infrastructure, AI-related infrastructure fund that they manage that's growing rapidly. Further diversification, attractive growth, solid yield, strong balance sheet. What else? Well, let's look at real estate. There are many ways you could go. You could go with a Cohen and Steers fund like RQY, or you could just pick individual stocks. And I think, for example, Realty Income's a great stalwart. You can sleep well at night with that one. For 5% dividend yield, close to 6% yield actually, and a solid dividend growth rate that'll be right in line with our target around 4%. A- credit rating, very well diversified, business models, strong balance sheet, proven management, great holding. And you can further augment that with, say, Mid-America Apartment Communities. It's a multifamily REIT, a phenomenal track record, strong balance sheet, dividend yield of over 4%, should be growing at a pace that easily beats inflation over time. And so there you go. That's another great holding to further round things out in the portfolio. Then you can look at business development companies. Now, these ones are a little bit flakier because their dividends are not quite as well covered. They don't really grow their dividends very well. And so if you just want to go with one, I wouldn't necessarily suggest this on a valuation basis right now, but on purely a yield and growth and a track record basis, I think it's a decent choice. Main Street Capital Corporation, it's probably the top BDC out there. Ticker symbol MAIN in terms of its track record. Possibly Capital Southwest Corporation is a little bit better, but MAIN is one that you could pick, really pick whichever one you want, but you'll get that mid-single digit yield from MAIN along with long-term dividend growth. Then rounding out the list really is my favorite sector, and that's the midstream sector. You got the likes of Enterprise Products Partners, and it's probably two of the very best. Strong investment grade credit ratings, low leverage, 7 to 8% yields, very well covered by cash flows, growing at a rate that meets or beats inflation in terms of their underlying cash flows and their distributions. Very defensive business models. It's really hard to top those. And so there you have it. You can see on the screen the full portfolio in aggregate. This is an example of how you could break it down by percentage allocation, how you can go about trying to build a portfolio that follows these principles, implements them in an attempt to build a passive income stream with just starting with $100,000 today. You reinvest the dividends, you regularly save your money. If you save, again, $40,000 a year, invest regularly with regular compounding, you should get to an income stream of about $60,000 in about 10 years from now. And again, that's going to be fueling consistent growth beyond that too, not just a high yield today that can meet your living expenses, but growth that should beat inflation over time and protect your purchasing power. Hopefully this video added value. If it did, please give it a like. That would mean a lot to me. And don't forget to subscribe for more content like this. Let me know your thoughts in the comment section below. And of course, remember, as always, this is just a brainstorming exercise, just a thought exercise to remind you that, hey, this is possible. It's doable. Everyone's circumstances are different. Everyone's journey is going to be unique. This is not financial advice. This is just information that should help fuel food for thought and perhaps conversations with a personal financial advisor that you choose to talk to. Thank you so much. I'll see you next time.